Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. We need to talk about real estate, both the housing market and the rental market, because there were some pretty significant changes that we just learned about from May of 2023. We've got 3 stats I want to give you and give you a little bit of analysis and commentary to help you understand what's going on in the economy, because the economy helps to inform our behavior, and our behavior helps to inform the stock market, and that is where we all invest. So let's go ahead and quickly break it down. This is your opportunity to like and subscribe as we break it down. All right, so the first thing is housing prices fell 3.1%. This is the biggest drop since 2011. Now, if you're like me, sometimes I think, oh, 2011, that's like 2 or 3 years ago. No, that was more than a decade ago, because it is 2023. So this is a very significant drop in housing prices. Why did housing prices drop? We know interest rates are high. When interest rates are high, it disincentivizes people from going out and making big purchases. We've been saying this for 2 years now. Okay, this is common knowledge if you have been around on the channel for quite a while. Now here's the big thing, really 2 big things. One, this is proof for everybody that real estate does not grow every single year. Okay, there are some people that think that, you know, your house is your best investment ever and it's always going to go up and it never drops. That is not true. Okay, 3.1% drop in housing prices. If you owned a home, your home could be on average 3% less valuable. Now, it doesn't mean that your house is terrible. It doesn't make it a bad investment. I don't think it's an investment at all. That's a conversation for another day, but I'm just throwing it out there. Okay, what this does show us is that people aren't buying homes at the same rate that they were, which means they are changing their behaviors. Okay, and this is done on purpose. This is why the Fed was doing this, but we do see it starting to work, and we do use housing prices to gauge a little bit of how the economy is growing and what people are doing with their money, because this is usually the biggest expense that people make, and according to some, this is the biggest investment that they make as well. So that is starting to change. It's starting to slow down. This is significant because housing prices were up 10% last year. So when you are looking at this as a chart, imagine an increase of 10%, and the very next year it is down by 3. That is a pretty big significant swing from positive to negative. So that's something that you do want to pay attention to. Is why, again, the Fed wanted to raise rates, but we're starting to see this taper off. The expectations from a lot of these real estate services like realtors.com and others did not expect housing prices to drop this sharply. They're starting to revise those numbers, so it shows you how sharply things are turning in, I would argue, a positive direction depending on what side of the fence you're on. If you're looking to buy a house, this is the positive side to be on right now, especially when housing prices are raising or increasing 10% a year. That's ridiculous. That is unsustainable, and things are starting to turn around. That is generally right now, some pretty good news. The next thing here is that annual home sales, is the volume of all the houses that were being bought, is down 20%. Now, I'm not throwing no shade. Okay, I'm not throwing no shade, but I felt like in 2021, everybody and their mom just randomly came out with real estate licenses and were selling homes. Again, everybody needs a good realtor, especially when you're looking for a house. So there's no shade at all, but it just felt like everybody was doing it. I have not seen anybody on my timeline doing it lately. Okay, and that is primarily because the volume of sales has dropped by 20%. Quite significant, and again, this is all due to the fact of how the Fed policies have changed and how interest rates have increased. To give you an example again, my interest rate was like 2.9%, it's right under 3%. Now interest rates are well above 6 and creeping towards 7. Remember, the Fed said that they are looking, or expecting rather, to raise rates at least 2 more times. So it is more than likely that it's going to be at 7% or higher. So you definitely want to be careful there, and that is again going to slow these numbers down a bit more in my estimation. It's already down 3% in terms of value, and volume has already stopped, or it's already down already by 20%. It could get a bit slower here by the end of the year and going into early 2024. So that's something that you do want to jot down, just having your notes, because again, I'm going to show you how this is going to file into the stock market, into the broader economy here in a second. The last thing here is that rent prices were down 0.9%. This is primarily because of the supply and demand. There was little supply, demand was high. That's why rent was so damn high last year, and it's just coming down just a tiny bit. And that's because we've been building a lot of apartments, multifamily homes, which we didn't need, because remember how all this stuff flows together. And that was one of the things I just loved about studying economics. I know a lot of people hated it. I know a lot of people fell asleep in class, okay? But it was fun to me because I was a nerd. I still am. But the main thing is, as we increase supply, rents can come down a bit and people can spend more money in other places other than just living at home, because you don't want to really see your income on your house go more than too far above that 30% threshold. Because if I'm spending so much money on my house, then, or my apartment or wherever, I'm not spending money at the grocery store, I'm not spending money on electronics, so Microsoft and Google and all these places don't get my money. Therefore, what happens to our stocks? They start to fall. So we want to make sure that people have affordable housing and they can spend money on all the places they choose to spend, which can help us as investors. So that's how this whole cycle really kind of goes around. But what we have seen, again, is that people tend to use, or I would just say economists, not just regular people, but economists tend to use housing prices, but more so rent prices in the inflation number. When you look at the official calculation for what we use for consumer price index, rent prices as well as fuel prices, gas and groceries, those are some of the primary factors that drive up inflation if those things are high. Rent has been the most difficult thing to bring down. Why do you think that is? It's hard to just snap your fingers and build a whole bunch of apartments. You can do a few things to bring down oil prices. You can do a few things to bring down grocery prices and have that become a bit more immediate, but you can't just magically build 1,000 apartments and increase the supply. But because we've been talking about this and people have been building over the last year and a half, those have finally started to come through and start to bring rents down just a tiny bit. Hopefully, this will continue throughout the next several decades, honestly, but definitely in 2023. So that is what's going on in the housing market. What does this mean for your portfolio and for how you should be looking at the stock market in general? Well, number one, remember, this is around the time that you should be making your semi-annual adjustments. Now, here on the channel, I always talk about making adjustments at least twice per year. My philosophy is you can do it anywhere between once a year, annually, and we've got research and things that show that that does work, or you can do it up to quarterly, which is 4 times per year or every 3 months. I like to do it in June. It is June right now. I got a few more days to get everything together, and then I like to do it in December, and that's just a check-in point. What do I know now, right, that I didn't know in January, and how can this help me to adjust my portfolio? In January of 2023, you couldn't have told me nothing about AI. Like, OpenAI was just a brand new thing, a month or two old, and now it's everything now. You see how quickly things have escalated. Do I need to make my portfolio or adjust my portfolio to pivot towards that, or pivot to another area of the market? Now, we did talk about inside Remembers Only a few stocks were off the radar and how well they were doing and which ones I thought were undervalued. We've already talked about that. Today, in our Remembers Only later today, I'm going to give you my stocks that I'm actually getting rid of, and you might want to be aware of those. So all of our members are going to get that and post later this afternoon. The last thing that you want to know as well is, again, because it's a part of, or used as a proxy, which means that we look at this and we kind of guesstimate where the economy is going. This does show that inflation could continue to fall and that things are slowing down. This does not say, okay, this does not say that this is falling off to a degree where we are absolutely running into a recession in 2023. I think I've made myself pretty clear on where I fall on that. What I'm most paying attention to of all of these numbers is not necessarily the real estate numbers, which I think are interesting and important, is really the unemployment. It did tick up just a bit from month to month from the last report we saw, but it is still under 4%, which is definitely where you want to be. So until that starts to change, that's when I would start to be concerned and start to worry. But right now, we're still in a very good spot. Regardless, good spot or not, you should still be investing, because long term, we have seen what the stock market has done even in what we would consider bad years. Even in recession years, the stock market still has risen in many cases. Remember 2020? That was a recession. There's a whole pandemic there too, but the stock market was up by the end of the year. So still, you should be investing. The question is, what should you invest in? Now, these are things we cover in our members only. Obviously, we talk a lot about index funds as well, which is where I think the majority of your money should be. It's where the majority of my money is as well. If you want to learn more about index funds, we have plenty of videos on this here channel. If you want to be a bit more advanced and learn how to invest on a deeper level, then you want to make sure you check out our members only. It's just $10 a month. That's it. You get exclusive content each and every week. All right, that is it for me. I will talk to y'all tomorrow. If you have any videos or topics that you want me to break down, you know what to do. Just put it in the comments below. All right, that's it for me. Talk to you later.